right, hello, welcome everybody. Sorry for the technical delay, but we are here. We are live. My name is Jason Hamilton, and I'm super excited to see you today. If I've never met you before, if you've never been to one of our workshops before, welcome. We do these every Sunday at 2 p.m. So we definitely want to really bring you knowledge that you can truly use every week and impact your retirement. So I'm going to post my information up right here. So that's me. I'm a chartered retirement planning counselor, and I'm the admin of this group and page. So if I've never met you before, I would love to say hello to you and welcome you here. And if you are returning, I want to say thank you so much for coming back and joining us again. So today we're going to talk about some really important things. We're going to really focus on investments today and asset allocation. And if you've never heard of that before, if that's a new term, don't worry about it at all. We're going to describe what it is, and then I'm going to walk you through a very simple 4-step process to follow as you are thinking about that. But I do want to remind you all that April is Financial Literacy Month. So if there's any month that you're going to work on your finances, it definitely should be this month. I was spending some time at the nonprofit just yesterday doing some coaching with some families. And what I've come to realize is that it never seems to amaze me, I should say, is that, working on your finances and getting your finances in order is just so impactful. It just changes lives. And so we have a program there called Ideal Wealth Academy where we work with families for about 9 months over the course of a school year with their parents and the high school seniors. And with the parents, we really focus in on, just getting a good household budget, focusing on savings and getting their plan on track for the future. We're about 3 months in from our first class on budgeting, and so we're really starting to see people take off with this concept of budgeting. I know many of you have been budgeting for years, and it's something that's just second nature, but I think there's a good chunk of folks that are going into retirement that have never done a budget before because, in all honesty, they had a paycheck coming every 2 weeks and they didn't have to worry about it. So I see this subject coming up more and more, lately. So if that sounds like you, then definitely want to make sure you get that retirement budget mapped out before you cross over into retirement. Really, really important stuff. So what I want to talk about today is investments, investment allocation. So if you guys can hear me, please let me know if you give me a comment or something. Just say, yes, you can hear me. Everything's coming clearly while I pull this up here. I'd appreciate that. I'm going to swap out scenes here, and we are going to share our screen with you here. So hopefully this comes up okay. Give me just a second here, and I will have that ready for you. I'm going to pop myself in the corner, and let's take a look here. Okay. If you guys can hear me, I'd appreciate if you can just let me know in the comments below. That would be great because I don't want to go through all this and then you couldn't hear anything that I said. So while I'm waiting for that, I'll talk a little bit about the 4 steps of asset allocation. So again, we're going to talk about in detail what this is, but essentially for anybody that has any sort of retirement account or investment account, where you put your money, right, in what sectors and what types of funds is essentially what your asset allocation is. So it's sort of like the pieces to the puzzle of your overall investment picture. So we're going to talk about in detail today, what that really means, and then a good process to think through your strategy when you're getting your asset allocation set up before and in retirement, and a couple pitfalls to watch out for, and some things I'm seeing over and over, and some things people are trying to do the right way, but just aren't coming out quite right. So hopefully you guys can hear me. I'm not seeing anybody saying you cannot hear me, so I really hope you can. Let me take a look here. Okay, anyways, hopefully it's going good. If you guys can't hear me, definitely leave a comment, and I will do my best to adjust that. So it looks like we should be in good shape here, and let's jump right in. Okay, so today what we're going to talk about is the 4 steps of asset allocation. And we're going to talk about having the right assets at the right percentages in the right location, okay? So it can be something you do simply, and maybe it's not that big a deal, but to get it really, really optimized, okay, good. I'm seeing the comments all came through at once. That's great. Melody, great to see you. Hear me from Michigan, huh? As you experienced an April snowstorm. No, thank you very much. Good. Welcome, everybody. Great. It looks like we can see, and everything's coming through clearly. So the right assets, right? So that means the right types of investments, the right percentages of those investments, and then in the right location, okay? because some assets are better off in different locations. So we're going to talk a little bit about all of these here. So let's just jump right in. Before we do, though, I do need to put up my disclosure here that nothing I teach you here should be taken as specific investment advice, or that you should just go do exactly what I say. You should definitely do your own research, get professional advice. But, I think what I'm going to show you is applicable pretty widely, and it is a good strategy. But when you get to the nitty gritty of your own personal strategy, you definitely want to take that on a case-by-case basis, okay? So what is asset allocation? Give me 1 second. I'm sorry. I got some things going on here that are just blocking my screen. Let me get this out of the way. My apologies. Okay, so let's go back to our window here and press play. Okay, so what is asset allocation? So what it means is the apportioning of funds among various asset classes in a way to meet your goals and reduce the effect of market volatility, okay? So most of you folks here are probably within 10 years or less of retirement. I know maybe some aren't, but the general majority is. And I don't think too many people will argue with me that, a few years before retirement, you don't want to have a ton of volatility, right? You don't want to see your whole portfolio go down 30, 40, or 50% the year before you retire. Okay, so having a proper asset allocation is really going to help reduce against that. And then even earlier on, having a good asset allocation is a great way, like I said, to reduce volatility, which at the end of the day is a good thing, okay? You want to have lower volatility and still capture the best returns you possibly can. And I do have to make a little note here down at the bottom. Like it says, before implementing your asset allocation, you must establish your goals and your risk parameters within which allocations can be effective. So before you get to this, you definitely want to figure out your risk tolerance and then what your goals are. So that's going to include things like timeline and really spending needs and things like that. So we're going to talk a little bit about that, but this is more just about asset allocation today. Okay, so why is volatility reduced? Volatility is reduced because, I put because twice, because different asset classes have returns that do not move together, okay? Because different asset classes that have returns that do not move together, which means they are not correlated. So this is really important. So I wanted to take an extra minute to talk about this, okay? So inside your portfolio, you're probably going to have anywhere from 5 to 8 to 10, different types of asset classes. You might have everything from large cap stocks, medium and small cap stocks. You could have some real estate, some precious metals like gold. You can have a lot of different things in there. And then you can even have subcategories, things like maybe you have some funds that are in the technology sector or in the healthcare sector, okay? But the idea with having non-correlated assets is so that when you have one asset class that may be going up, you might have another one that might be going down. Obviously, we want everything to go up together, but in all honesty, if all of your investments are all going up together, that means they're probably too correlated or overly correlated. So that means if everything goes up together, then everything's going to go down together, and that's not what you want, okay? So you want to set up your portfolio so that you have a good amount of assets that are not correlated. So for example, last year was a little bit of an anomaly, but in general, stocks and bonds are not correlated, right? So a lot of times when stocks go down, then bonds go up in value. And so that balances out and reduces some of that volatility in your portfolio. And other things like real estate or precious metals can do the same thing as well. So here's like a visual of what market volatility could look like, right? That's part of the game. If everything is just fixed and it's going up perfectly every single time, that means you're probably not earning what you could be earning over the long term. It's good to have some fixed assets, and it's good to have some things that are very conservative that will pay out that income that you need. But over 10, 15, or 20 years, if all you're making, which right now is probably 2.5% to 3%, if that's all you made, really the value of your money is going to be going down every single year because of inflation. So it's good to have some of your money, and for different people, it's different amounts, but it's good to have some of your money that is working for you in the market for the long term, and then some things that are more conservative for the short term, okay? But when we have market volatility, ideally, part of your portfolio is going to go up to balance against that while the other part goes down, and that's sort of what it would look like here. So hopefully this is a helpful visual for you. Okay, so in addition, there's different classes of assets that have different risks and different returns, okay? So this is really important because, having everything that's all the same level of risk, that's not great, right? You want to have things that have different risk and different returns so that the different parts of your portfolio are working together to keep you kind of moving up, right? We want to see things moving generally up, even though we might have some squiggly lines in between, like I showed you on that previous picture. So when implementing asset allocation, here are some of the high-level factors to consider. Number one is goals, right? Goals and constraints in your investment policy. If you don't have an investment policy statement or haven't gone through a deep dive into your financial profile, your investor profile, and your risk analysis, that's something I highly recommend you do. Most of the clients I work with have never done that, right? They've never taken the time to work with a professional investment advisor to really help them design that proper asset allocation so that they are set up accordingly to their overall risk tolerance, their timeline, and their goals. And then ideally, once you have that, then that would be part of your investment policy statement. Okay, risks, returns, and correlations associated with and between different asset classes is something else you want to consider. And then also your sensitivity to risk. Okay, some people are very sensitive. If they see their portfolio like we had at the end of last quarter, we saw 5 to 10% drops at the end of last quarter of 2018. A lot of people were completely freaking out, right? And that was only about maybe a 10% drop, even with the reasonable balanced portfolio. And that brought that feeling up sometimes that you get in your stomach. From what I hear, it's usually in your stomach, right? Where you get that feeling, or in your chest, that, oh my goodness, what's going to happen? Oh my goodness, am I going to lose money? So people have different sensitivity to risk. And then some folks are just like, that's great. That's what I want. So someone like me that is managing portfolios, I like a little volatility because that gives me the opportunity to do some rebalancing and buy things at a discount sometimes because, hey, you know what? Our goal is to get you the overall lowest cost per share of the investments that you're buying. So over time, whatever that investment is worth, the lower that you paid, anything above that for what it's worth is your gain, right? So we want to have the best gains that we can have. And by rebalancing and buying things at a discount when the market is down, that's a great way to do that. But I know not everybody feels like that, and a lot of you are extremely risk averse. And so you want to make sure you're setting up your asset allocation appropriately for that. Okay? And then the other thing is your investment timeline. Okay? If you are 20 years out from retirement, then you could take a lot more risk than somebody that's 3 to 5 years out. If you're 3 to 5 years out from retirement and you have an 80 or 90% stock portfolio, and it goes down 30, 40, or 50% potentially, and if that's a year before you want to retire and it's down for a year, that's going to bring a lot of stress, right? So investment timeline is really, really important to this. And in the next couple of weeks, I'm actually going to talk a lot about sequence of returns risk, how to mitigate that, and then also setting up income portfolios that will give you the income you need in those early years, but then give you the growth you need later years. So that's a preview of what's coming very soon here, okay? But it's important to know that. Okay, so let's talk about this. Step one, okay? Step one is you want to determine which asset classes should be represented in the portfolio because all asset classes are not for everybody. Okay, so to start, I think you'll need the risk return characteristics of each category of investments. Okay, so when you're looking at the risk and return characteristics of a large cap stock fund versus a small cap stock fund, and then you look at that versus something like a real estate investment trust or a REIT fund. And then you look at that against commodities or precious metals like gold. You want to look at the risk return characteristics of each category of investments. Okay, and like I mentioned before, the correlations or lack thereof. Because let's say in general, the U.S. stock market, for example, you think you might be diversified because you have maybe an S&P 500 fund and you have a small cap stock fund and you have 2,000 or 3,000 stocks within that portfolio. It's diversified in a sense, but it's also highly correlated, which means it's probably going to have the same type of movement. So that's not always good to have only that. You want to balance that out with different types of investment categories. Okay, and then again, going back to risk tolerance, I'm going to be talking about this over and over because risk tolerance is just so important to get right. And this is really that sleep number that can lead you into making a bad decision if you don't get this right. And one thing I want to make you aware of is, because don't feel that if you are like short on retirement, like you don't think you have enough and you're only a couple years away, probably one of the worst things you can do is take more risk than you're comfortable with chasing returns, right? That just usually doesn't turn out well, so be very, very cautious on this part. But the rest of it, I think, it's pretty easy to figure out these days. Okay, and then again, your timeline. Okay, so do you have 1 year until retirement, or are you already in retirement? Do you have 5 years or 10 years, or do you have longer? Because that's really going to determine the type of asset classes that you use. You're probably not going to have as much of the small cap funds really close to retirement as you might have earlier on, right? Those high growth funds. Those have a lot of volatility, but over time have done very well when it comes to returns that you've been able to make. But if you're 1 year away from retirement, sure, having a little bit's good, but you don't want to have 50% of your portfolio in a high growth, high volatility fund. Not a good idea. Okay, and then a good starting place for most people is looking at like stock funds, bond funds, and cash, right? So just considering those three categories as the main categories, but you also may want to consider some real estate, commodities, and precious metals, like potentially gold. Like, I'm not a huge fan of gold, but a little bit's okay. Not the end of the world. But real estate pays good dividends, the real estate funds, the real estate investment trusts. So I've seen folks take real estate funds and then substitute that out for a bond fund, for example, for a very small portion of their portfolio to try to generate a little bit of extra income. There's some different things you can do depending on, again, risk tolerance, timeline, and goals. Okay, but once you have decided on your asset classes for your portfolio, then we can go to step 2. So once you figure out, okay, I know I want to have maybe some U.S. stock funds, some international funds, maybe some developed markets and some emerging markets. I want to have some bond funds, and I need to have multiple durations, right? So duration is basically how long until the bonds mature, and how long until you get your money back. So the short-term duration, so if it's like 3 months or 6 months or a year, those are probably paying 2 or 3% right now max. But you can find some funds that are going out a little bit longer, and those might pay 4, 5, or 6%. Excuse me. And then on the international bond funds, those are paying a lot higher, but in turn for higher payout, you're going to take more risk. Okay, if you're like me, you believe the markets are very efficient, and that if you're going to take more risk, you should receive more reward. But there's no such thing really as a free lunch in investing. You really have to take more risk to get higher returns. So really want to look at, what is that desired return that you need, and then what categories of investments you're comfortable with, what categories of assets you're comfortable with, and then once you have that, we can go here to step 2. Okay, so then step 2 is determining the percentage of each asset class. Okay, so this is a critical step for each individual, and this is going to vary, right? So there's a lot of folks out there that'll just say, everybody can just do this 3-fund portfolio or whatever, and there's nothing wrong with that necessarily. But if you're strategic and you can do little things like tilt to like a small cap fund or small cap value fund, you might be able to eke out a little bit of return without taking much more risk at that point. But this is a critical step for each individual because it determines the fundamental risk and return relationship of the portfolio. So like I just mentioned, if you believe that markets are efficient for the most part, then you know that you're going to have to take more risk to get more return. So balancing your risk-return relationship is going to be really important. So when I say determine the percentage of each asset class, that means how much large cap stock are you going to have? How much mid cap stock are you going to have? How much small cap? Again, how much of those international funds are you going to have? What percentage? And then how are you going to break that up? Are you going to have, say, 10% developed and 5% emerging markets? These are things that each person has to decide individually, and you really want to get a good perspective on this. Sometimes buying those all-in-one funds is okay, but ideally you want to get an individual perspective on this, okay? But there is honestly almost an endless possibility of combinations. So what I don't want you to do is just sit there in analysis paralysis and just keep everything in cash because you can't figure this out. Starting somewhere is good, but getting this really dialed in, especially if you're going into retirement sometime soon, is really crucial to making sure you can generate enough income and making sure you don't face too big of a downturn at the wrong time, okay? And that goes back to your sequence of returns risk. So what that means is early in retirement, if you're drawing large amounts, for example, because you're doing a bunch of vacations or you're spending on like an RV, and then we also have a market downturn, that can cause a lot of problems and put a bunch of risk on the back end of your retirement success and reduce that possibility of success. So we don't want to do that, okay? But it's important to do that. So the main question you want to ask is, what is best for you, okay? What do you understand? What do you feel comfortable with? What sort of returns do you need to generate to make sure that you can fund your retirement? anytime we get a chance to lower risk but still be able to fund retirement, I think that's a good thing to do. And that's part of what I'm going to talk about in a second, but reevaluating your portfolio on a regular basis. But you have to look at what is best for you. Don't just take what somebody on the radio says. Don't just take what I say. Don't just take what anybody else says unless they've really gone through an in-depth analysis of you and your personal situation, your personal goals, and your personal risk tolerance, okay? So 3 considerations here. Let's say early retirement. This is a big one. How much cash flow do you need to generate, right? So that's a big question. So, if you need to generate a certain amount of money and you are very low risk, well, then really have to look at the types of income paying stocks or bond funds that will help you meet that goal. Number 2 question, again, we talked about this, but what is your timeline? How much time do you have? Are you 5 years out from retirement? Are you 5 years into retirement? These are very, very important questions when it comes to figuring this part out. And then how much fluctuation in the markets could you handle and still meet your needs? So for example, if the market had a 20% downturn, how would that affect your ability to generate the income you need to survive? Could you hold off and take less money out of your portfolio during that year or two while the market was down? Or is that going to cause you to not be able to cover your baseline expenses? That's a really important consideration when it comes to deciding on your allocation. If you have more money than you need and you're generating more than you need on a regular basis, so if the market went down 20% or 30% and you still be fine, hey, maybe you can up the risk a little bit and take a little bit more for potentially higher returns. So these are things you want to think about on your exact situation. Okay, but when it comes to coming closer to retirement, you're gonna have to deal with these 2 contrary risks, and it's kind of funky because you have to deal with 2 things that kind of go against each other at the same time. Number 1 is protecting against market risk. Okay, so protecting against market risk by having low volatility and fixed income securities, and then you have to protect against inflation risk with stocks and stock funds. So short term, you don't want to have a big downturn on your whole portfolio because you might have to have that fixed income that keeps you, with the income you need to survive. But over a period of 15 or 20 years or 30 years for a whole retirement period, if you kept all your money in funds that are earning 1, 2, or 3%, then you're going to be affected by inflation risk down the road. And so that's why you got to have a little bit of equities in there potentially. Again, maybe you don't if you are completely funded for your retirement, but for most people, they're going to need to keep a portion in equities. And so again, that is individual. You will also want to consider other reliable sources of income when it comes to your asset allocation. So thinking about things like your pensions, your Social Security income, any annuity streams, and also your family longevity. Because let's say, for example, you have Social Security income and a pension, and between those 2, that's going to fund all of like your basic needs. Well, then you can really dial up the risk on your portfolio, because if the portfolio dropped for a couple of years or 6 months or a year or whatnot, and you could still fund all your needs, not a big deal. But over time, higher equity proportions in your portfolio has generally delivered higher returns. So if you have a lot of fixed income, that could be great. You can up that risk. But if your only income stream is Social Security, for example, and maybe you took it early, at 62, and so it's a pretty small portion of what you need, well, then you're not going to be able to take quite as much risk in your investment portfolio potentially, because you need that money to live off of, right? So these are things to think about. So once you decide on the percentages of each asset class, and then you consider these other things like I mentioned here, then you can go on to step number 3. Okay. Step number 3 is security selection. Okay. So the importance of security selection is often overlooked in the asset allocation process. So what that really means is, what stocks are you going to use? What bonds are you going to use? Or what stock funds or bond funds are you going to use? But a really great way to overcome bad selection is to just use broad-based index funds that represent their asset classes, right? So, if you want to have a certain percentage of large cap stocks or growth stocks, you can, pick a fund an index fund that represents that. Same thing for small caps, same thing for even bond funds. The idea is, what percentage of those funds do you keep in your overall portfolio to help you meet those needs? But a good way to, to help against picking bad securities, because maybe you want to have some single stocks. If you pick the wrong stocks, that could cause a lot of problems, even if you're technically diversified because you have 20 or 40 different stocks. If you pick a bad one, something like an Enron, for example, or even a GE in the last couple of years, that can affect your portfolio in a majorly negative way. So broad-based income index funds are a great way to do it. They're generally low cost, and it's a good way to build a portfolio, I think. Okay, so what I don't recommend is selecting a series of target date funds and calling this diversified, okay? So target date funds, and the reason I bring this up, first of all, is because I keep seeing this over and over. But if you have a target date fund, they're designed to be an all-in-one portfolio, because what target date funds are generally is a fund that has other funds inside of it that's managed for you, okay? And it's usually like a year base. So it might be like a 2020 fund or 2030 fund. And if you have just that one fund, that might be okay, but they're generally more expensive than just building it yourself as far as what you pay every year to have that fund. But what I'm seeing is folks are having multiple target date funds trying to diversify. And that's just not good. That's not the proper way to do it, because what that gives you is fund overlap and an inability to measure performance accurately, since the target date funds, like I said, are usually a series of different funds themselves. So what I mean by that is, let's say you have a 2020 fund and a 2025 fund. Well, those are probably going to have about 40, 50, or even 60% or more of the same funds in there, so they're going to have overlap, okay? So same funds inside there. So if you're trying to look at performance of the underlying funds, you can't make changes, you can't do a whole lot to it. And so when you're trying to figure out what you should have, again, it's not the worst place, it's not the worst thing you can do by far, but having 2 to 10 of these things, which is what I'm seeing a lot, is not proper asset allocation or proper portfolio management. So I would definitely recommend that if that's you, you get some assistance on that. And then even having one target date fund with other single types of funds kind of around it, again, not the right thing to do. I would either build your own portfolio or keep it all at one target date. But the idea is that you have optimally balanced portfolio for your needs. Okay. The other second problem with target date funds is they're usually age-based, and age-based is okay. And the reason the 401k companies do it mostly is because they have a fiduciary standard and they have to make it like applicable to everybody, because they're not giving you individual investment advice. So it's just something that they can do and still meet their fiduciary duty. But in many cases, there's folks that may have a different level of risk tolerance than their age indicates, right? Or they may have a higher, could be higher or lower in that case. So if you're going to use a target date fund, I would go back and figure out what's your risk tolerance, what's your timeline, what are your goals, what do you need to generate for returns, and then based on the asset allocation you need, then you could pick the right target date fund, and that may have nothing to do with the year that it says on that actual fund. Okay. So if you choose to own individual stocks or bonds, I want you to make sure that you're diversifying across the various industries and don't go too heavy, in your personal company stock, right? So example, Enron. Enron, I bring it up because everyone knows about it, but folks in that company had like 100% of their 401ks in Enron. And so not only did that company crash, their 401ks crash, and it ended up really bad. Is it bad to buy your company stock if you believe in your company? Not necessarily. You might be able to get a discount, right? You might be able to get a 10 or 15% discount on that stock, but having too much company stock is not a good thing, and it does add more risk to your portfolio than is probably necessary. But something you can do is buy it, keep it until you can actually sell out of it, until it vests, and then reinvest that back into your overall portfolio. Take the 15% discount, and then hopefully it doesn't go down, and maybe you made a good chunk of money on that. It's a good way to do it. Okay. All right, so a good question to ask yourself is, if one of your assets collapses, will it change your lifestyle, right? So if you had all your money, like 50% of your money in your company stock, and let's say your company goes bankrupt and that stock goes to zero, will that affect your lifestyle? Okay, those are things to think about, okay? And then this is extra important for retirees who do not have the income to make up for losses. If you're 40 years old and you have 20 years until you want to retire, and you make some bad choices and the market goes down, you have to sell off and buy some new things, well, at least you have 20 years and you can put more income into the portfolio. But for most retirees, they have a fixed income portion like Social Security or pensions, and then they have a portion from their investments they're generating. So too much risk in one sector, it can cause a lot of problems down the road. So I don't want you to have too much there, and just be really careful with that, especially if you're close to retirement. All right, and now we are on to step number 4, which is performance review and investment climate, okay? So right now is a very important time to consider this. So it's been about 10 years since a large market correction. if you know me, you know I am not Chicken Little. I'm not Dr. Doom. I do think you should stay invested in the market through all conditions, but I'm a big fan of rebalancing if you do have market changes. The idea is you should not have more risk than you can handle for your particular timeline, right? So jumping in and out of the market, I know some of you have done a good job in the past, right? And you picked the right time, for example, but there's no proof that anybody can do this over a long period of time. So I highly caution you not to try to time the market. But I do want you to take into consideration that the market does go in cycles, right? Every 10 to 15 years, we generally have a correction. We had a minor correction at the end of last year, which is great in the sense because that broke up that decade-long, bull market. And so, was it a real correction? Maybe, maybe not. But there's, always things that could be coming and we don't know when to expect them. So that's why you want to be very properly diversified. And if you are, you can take advantage of the times when we do have a market correction. Okay, so I do recommend reviewing your investment performance on a regular basis as well because it's important. But you want to be cautious when you're making decisions on short-term performance. If you have a fund that just performed poorly for like a year or two, you may not want to just jump right out of that fund. You really want to look at it over time. But over, say, a 5 or 10 year period, if this particular fund is supposed to represent, say, the small cap index, but it's consistently underperforming because maybe you have an actively managed fund, then at that point, you might want to swap that out for a different type of fund. But if you are buying the indexes, then you're just going to give the index returns and it is what it is, right? So that's more for you that want to do some more active management or some stock picking, okay? All right, and then the next question ask yourself is, does the economic outlook represent an opportunity or a reason for concern? Right now, I don't know. Things look good overall, but again, it's been 10 years. So, I'm a little bit on the defensive side, but I still think, you should have some growth parts of your portfolio for sure. Because if you look at the beginning of this year, we have, like S&P's up, 11, 12% at this point. So you would have missed out on that if you're sitting in all cash. So that's not a good thing either. But you always want to be a little bit cautious, I say. And then when you're looking at your overall investments, is the performance as expected? One thing when you look at long-term performance on the different sectors and different asset classes is that what really happens over a long period of time is things generally revert to the mean. So what that means is they generally average out. So, if something's underperformed for a while, there's a good chance it's going to have a good performance, say, the next period of time. If something's overperformed for a while, then there's a good chance that that particular sector or that asset class could underperform after and revert back to the mean. So you really want to look at, okay, what's the expected return for this asset class? And then based on that, am I in line with that or am I way off? So those are things you want to look at when it comes to reviewing your investment portfolio. And I do recommend at least 2 times a year that you review your portfolio. If this is not something you're comfortable with or you have the knowledge of, then definitely consider working with a professional. Okay, and then if you decide to make any changes or adjustments, then go back to step 1 of this process and review all available data, okay? All right, so I'm gonna take some questions right now and see if you guys have anything you wanna talk about. But if you would like help with setting up or managing your asset allocation, I'm happy to discuss it with you. And you can schedule a call with me at keepitsimplefinancial.com/talk. There is no charge, no obligation, and just some folks need some assistance and I can help you out with that. And give you some insights on how to think about this. So if you have any questions, go ahead and put those down in the comments right now, and I will take a look to see if there's anything I can do to help you out, okay? So let's see. Alex asks, if I'm going to retire in 2025, is it a good choice to have 100% of my 403B in the Vanguard 2025? I have to look at that fund, and Alex, that question really, like I said, if you're gonna have a target date fund, you don't really know. Does that asset allocation meet your timeline, your risk tolerance, and your goals? It could. So it could be the right fund, but I would really encourage you to get some advice on getting the proper asset allocation. And then if that aligns with that particular fund, then that can be okay. But is having 100% of your money in a target date fund versus 5 target date funds better? Yeah, probably. It's probably better to do that. So, but really good question there. Not seeing any other questions come in here. If you guys have any, go ahead and drop them down below, and I will be happy to do that. All right, let me take a look here. Okay, I'm seeing some more questions. Nope, those are on a different thing. Okay, so that's pretty much what I have for you guys today. And I'm gonna exit this here. What I want to make sure that we drive home today, guys, is that you have the proper asset allocation for you personally, okay? Don't listen to what someone says that's on the radio. Don't just take someone's advice that's never gone through and looked at your whole situation and made sure what you need for your particular retirement. This is a very individualized decision, okay? So if you need help with it, happy to help you. My website is right here. You can schedule a call with me there. Other than that, I will wish you a wonderful and happy weekend. I appreciate you all watching, and we'll talk to you very soon. Bye-bye now.